For years, Danaher was one of Wall Street's favorite compounders, consistently delivering strong growth through acquisitions, operational excellence, and disciplined capital allocation. Then the story changed. As biotech funding slowed and post-pandemic demand normalized, revenue growth stalled, investor sentiment weakened, and many began to question whether Danaher's best days were behind it. But beneath the surface, something has started to change. The latest results suggest that growth is returning, cash generation remains exceptionally strong, and the company's long-term competitive advantages are still firmly in place. So is this simply a temporary rebound after a difficult cycle? Or is Danaher quietly entering the next phase of its long-term compounding story, while much of the market is still looking in the rearview mirror? Let's examine the evidence. To understand why Danaher's recovery matters today, we first need to understand what caused investors to lose confidence in the first place. During the pandemic, demand for diagnostics and life science tools surged to unprecedented levels. But as COVID-related testing faded and biotech funding slowed, that extraordinary demand quickly normalized. Laboratory customers delayed capital spending, growth decelerated, and investor sentiment shifted almost overnight. For the first time in years, Wall Street began questioning whether Danaher had lost the growth engine that made it one of healthcare's premier compounders. But was this the beginning of a structural decline, or simply the low point of a cyclical downturn? This is the question that matters most. Investors are not debating whether Danaher is a high-quality company. Its track record of operational excellence, disciplined acquisitions, and strong capital allocation is already well established. The real debate is whether those strengths can still translate into sustainable long-term growth. Because for a compounder, quality alone is never enough. It must continue to reinvest capital, expand its market opportunities, and generate consistent earnings growth over time. So before we examine the latest results, we need to answer one critical question. Has Danaher's compounding engine actually weakened, or has the market become too focused on a temporary slowdown? The latest quarter suggests that the narrative may finally be changing. After several quarters of muted performance, Danaher returned to positive revenue growth, while core revenue also moved back into positive territory. More importantly, the improvement was not driven by a one-time event but reflected broader stabilization across key businesses. For long-term investors, this matters because market sentiment usually changes long after fundamentals begin to improve. The recovery may still be in its early stages, but the first signs are becoming increasingly difficult to ignore. The next question is even more important. What exactly is driving this recovery? One of the biggest headwinds for Danaher over the past 2 years has been the sharp slowdown in biotech spending. As funding became more difficult and research budgets tightened, many biotech companies delayed purchases of laboratory instruments and reduced capital investment. That directly impacted demand across Danaher's life sciences business. Today, those conditions are beginning to improve. Funding activity is stabilizing, customer spending is gradually recovering, and research programs are moving forward again. Danaher doesn't need another pandemic-driven surge to grow. It simply needs the biotech industry to return to a more normal investment cycle, and that recovery may already be underway. Not every healthcare company will benefit equally from a biotech recovery. Danaher enters this phase with a unique advantage. Its portfolio spans life science research, bioprocessing, molecular diagnostics, and analytical instruments, making it deeply embedded across the drug development ecosystem. When research activity accelerates, Danaher doesn't need to win new markets overnight. It simply benefits as existing customers increase laboratory activity, expand production, and resume capital spending. That's the power of an integrated platform. Rather than depending on a single product or therapy, Danaher participates across multiple stages of scientific innovation, giving it a broader and potentially more resilient path to recovery. While investors focused on slowing revenue, another part of the business remained remarkably resilient. Danaher continued to generate strong operating cash flow and healthy free cash flow throughout one of the toughest periods for the life sciences industry. That matters because cash flow reflects the underlying economic strength of a business. It gives management the flexibility to invest in innovation, pursue acquisitions, and navigate industry downturns without compromising long-term strategy. In other words, the growth story may have slowed, but the financial engine that supports Danaher's long-term compounding never truly stopped running. Danaher's recovery is not built on the hope that old demand will simply return. The company has spent years expanding its capabilities across life sciences, bioprocessing, molecular diagnostics, and precision medicine. These are markets supported by long-term trends, including biologic drugs, personalized medicine, and an aging global population. As research activity normalizes, Danaher is positioned to participate in multiple areas of healthcare innovation, not just one. This is why the recovery story is bigger than a single earnings report. It may represent the beginning of Danaher's next phase of long-term growth, rather than the end of its previous one. Markets often anchor their expectations to what happened over the past few quarters. In Danaher's case, investors remember slowing biotech demand, weaker revenue growth, and post-pandemic normalization. Those challenges were real, but markets don't reward the past. They price the future. If the operating environment continues to improve, today's market narrative may no longer reflect tomorrow's business performance. The key question is no longer whether Danaher experienced a slowdown. The more important question is whether investors are recognizing that the business may already be moving beyond it. The latest quarter is encouraging, but one strong quarter doesn't establish a long-term trend. Going forward, investors should focus on three key signals. First, whether core revenue growth continues to improve across the life sciences and biotechnology segments. Second, whether customer spending in biotech continues to recover as funding conditions stabilize. And third, whether Danaher can translate improving demand into consistent, sustainable growth over the coming quarters. These indicators will tell us whether this is simply a short-term rebound, or the early stage of a much broader recovery story. Every great compounder eventually faces a period when investors begin to doubt its future. For Danaher, that period was defined by slowing biotech demand, post-pandemic normalization, and weaker growth expectations. But if the recent improvement proves sustainable, this quarter may be remembered as more than just a better earnings report. It could mark the point where Danaher shifted from managing a cyclical downturn to building its next phase of long-term growth. And for long-term investors, recognizing that transition early can matter far more than reacting after the market has already changed its mind. Danaher doesn't need to become a different company to create value again. It simply needs to do what it has done for decades, execute with discipline, allocate capital wisely, and compound growth over time. The latest results don't prove that the turnaround is complete. But they do suggest that the foundation for a recovery is becoming increasingly visible. The market spent the past 2 years focusing on what Danaher had lost. The next chapter may depend on recognizing what the company has quietly regained. Because sometimes, the best investment opportunities don't begin when the headlines turn positive, they begin when the fundamentals do. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.